Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Frontier stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 780 million market cap. They're trading at a measly $3.49 a share, and they have 224 million shares outstanding. Frontier provides low-fare passenger airline services to leisure travelers in the US and Latin America. They sell their products through direct distribution channels, including its website, mobile app, and contact centers. It has a fleet of 136 Airbus single-aisle aircraft. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2021, then it took a turn for the worse. Negative 230 million in 2022, even worse in 2023, negative 348 million. It's pretty much the same in the trailing 12 months, negative 340 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every single year. So they really need to turn it around. Revenue is the sales for the company, and that looks okay. It goes from 2.1 billion to 3.6 billion. A pretty good growth, but even though their revenue is growing, their profits are negative. Usually with higher revenue, you pass your break-even point and become profitable. I kind of understand negative free cash flow if they're investing a lot towards the future, but negative net income implies their day-to-day expenses are still really high, higher than their revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 224 million shares. And we get a calculated stock price of $4.47. They're trading at $3.49, so they're trading at a 22% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. Unfortunately, Simply Wall Street does not value this stock. But there are 12 analysts that price the stock at $12, so they say it's pretty undervalued. There are 16 companies in the same industry as Frontier, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $88 million in CapEx. So it doesn't look like they're buying many planes. So that's not a good sign that they still have negative free cash flow and they're not investing in CapEx. They're really leveraged. Debt to equity ratio close to 8. That means for every dollar of equity, they have $7.80 of debt. Negative free cash flow, like most companies in this industry, they rank 10th in market cap. Price to book is pretty good at 1.3. That means investors are paying $1.30 for $1 book value. Price to book is market cap over equity or stock price over book value per share. We can't look at that PE, negative earnings. We can't look at that price to free cash flow, negative free cash flow. Price to sales looks pretty good at 0.2. This implies investors are paying 20 cents for $1 revenue. They generate more revenue than the median, also more than SkyWest, and SkyWest is more than triple the market cap. We can't look at their 5-year annual revenue growth rate. They started trading in the beginning of 2021, less than 5 years. Here's their latest income statement. Revenue is pretty much flat. In the second quarter, it's 970 million. Passenger revenue, 950 million. Other revenue, 20 million. Their biggest expense is fuel, 288 million. Wages is second biggest, 240 million. Aircraft rent, they have to pay rent at airports, 147 million. Station operations, 160 million. This includes a lot of things like baggage, passenger ticketing. Then you have maintenance of the aircraft, 42 million, marketing, 47 million. So expenses, 948 million, up from last year. So operating income is down. It was 79 million, now it's 25 million. They spent 8 million of interest on their debt. Pre-tax income, 32 million, 1 million of taxes, pretty low tax rate. So their net income is 31 million. EPS more than cut in half, from 32 cents to 14 cents. So to summarize, I have them trading at a 22% discount, but this stock looks real rough. It looks like it's on the verge of bankruptcy. I give them a ranking of 2 out of 10. Would I buy them? 1 out of 10. Ratio is 2 out of 10. They do have a good price of sales, but we can't look at that PE or price to free cash flow. Financials, 4 out of 10. The only reason it's that high is because their revenue is up 75%, but their free cash flow looks awful. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.